Thanks very much, Eric. Thanks for coming today. Last day of a long series of meetings. So I'll try and keep this brief. The title of this presentation is What is Wrong with the Gold Mining Industry? It's not a very popular presentation at a gold mining conference. But I think it's important for us to understand what can go wrong in gold mining to try and better pick stocks which are capable of outperforming and avoiding some of the errors which have been made in the past. So here's the horrible truth. Most of us buy gold mining shares to outperform the price of gold to get some kind of leverage. If we look over the past 25 years, you can see that the price of gold has risen in US dollars by about 250%. The total return on the GDX has been 20%, and the total return on some of the majors, and I've put Barrick there, dividends reinvested over 25 years, the total return has been minus 5%. So clearly something's going wrong here. Mining stocks are supposed to give us a leverage effect on the commodity that they produce, and that's not been the case for gold mining. Just a quick example to show that really the problem is a very specific gold one in other subsectors in the mining industry, people mining other commodities. They succeed in creating this leverage effect. Here's a chart of Antofagasta versus the copper price over the past 25 years, and you can see copper's up just under 100%, and Antofagasta, which is a mid-tier pure copper miner, has given a total return of about 410%. So clearly the leverage effect is there in other types of commodity. So why has gold mining serially underperformed the price of gold? I think there are two main explanations, and I think that they're connected. And the first one's a geological reality. There's not a great deal anybody can do about it. We find gold in relatively small quantities. That's why it's precious. That's why it's valuable. But it does mean that the mines tend to be much smaller, and therefore they have much shorter mine lives. And there you can see, I mean, the average life of a gold mine today in the world is about 7 years. The average life of a copper mine is 35 years. And that means that you've got a very short period to get a return on your initial capital investment. And if with a bit of bad luck, those 7 years happen to be poor years for the gold price, well, you never get your initial capital back, let alone a return on that capital. Excuse me. I think the second thing which has destroyed a lot of value in the gold mining industry is the fact that, is the management reaction to that structural problem in the industry. And their reaction is an instinctive one, a natural one. Every time the mine produces any cash, they reinvest it back into the business to try and prolong the mine lives. Because when you've only got 7 years of job in front of you, your tendency is to try and do everything to prolong that period. And that might not be a bad strategy, but for the fact that because gold miners have relatively high costs, they only really have money to invest when the gold price is high. And that means that they tend to make most of their investments when the gold price is high, at the top of the market. And when the gold price is low and asset prices are cheap, they don't have any money, or they may even, if they've got too much debt, be forced to sell at the bottom of the market. And there you've got a little chart of Barrick's capital investment versus the gold price. And as you can see, as the gold price rose, whoops, oh, it seems to have turned it off.
No, there's definitely a connection error somewhere there. Sorry about that. It happened this morning.
You got the baby seal back?
Yeah, I got that back.
Secret code.
It was secret. It's not mine, but thank God it's simple enough. There, sorry about
Great,
that.
thanks very much. So, yeah, this is just Barrick's capital investment versus the gold price over the past decade or so. And you can see that that's the year-end gold price in red. You can see as the gold price rose, the capital expenditure budget of Barrick exploded. And as the gold price fell, well, they were obliged to rapidly cut their capital expenditure budget and even start to sell assets. So the maximum of investment was made at the absolute peak of the gold price with the consequences that we all know. I think the other thing which has destroyed a lot of value for shareholders in gold mining companies over time has been a kind of uniquely poor corporate governance which has prevailed in the sector. And I'm not quite sure why this has been allowed to happen by shareholders, but it certainly has. I've taken the example of Goldcorp and Newmont here, which is a particularly egregious one. And so the last CEO of Goldcorp joined the company in 2016. He had a fixed salary of 10 million Canadian dollars per year. During the 3 years that he managed the company, he destroyed about $3.7 billion US dollars of capital value, and the stock underperformed the GDX by a little bit over 40%. So he took 10 million per year for 3 years, and when he sold the company to Newmont, pretty much at an historic low for the share price, he took another $15 million for compensation for loss of office. So $45 million for him, minus $3.7 billion for the shareholders. The second aspect to that transaction, I think, which is interesting, is why the hell did Newmont buy Goldcorp? And I think that there again, it's an illustration of the poor incentives in the industry. The only reason I can think that Newmont wanted to buy Goldcorp is because Barrick had merged with Randgold, and that put them in the number 2 position in terms of production in the world. And they didn't really like that very much, so they had to buy something quickly, and Goldcorp happened to be for sale. And you've seen in the disappointing earnings that Newmont's had since the transaction that the source of the disappointment was almost exclusively the assets that they acquired from Goldcorp without having done sufficient due diligence. So that's for the large cap sector. Whoa, it seems to have blown up again, sorry. We need the secret code again. So while Eric does that, I'll just carry on because time is short. So the next slide, when it comes up, you'll see is just a short slide about the smaller companies sector, which has been quite a poor performer, as I'm sure all of you know, over the past few years. And I think that there are some structural problems there. Well, we're going to have a bit of technical help here. Okay, so what I put here is a chart of the performance of 6 smaller companies in the gold mining sector. They're not bad companies at all. I've held some of these in the past and hold some of them still today. But you can see since, so over the past 2 years, these stocks have seen absolutely swinging declines in their value. Here I think we have a structural problem as well. There's over 2,500 mining companies quoted in the world with market caps under 500 million, and 2,000 of those 2,500 are precious metals companies. So there's a huge dispersion of the effort and the capital in the sector. And having so many small companies means that they're in massive competition with each other for capital. Because their shares are illiquid and they're often single asset companies, they have a very high cost of capital. So many of these companies trade at 0.2 or 0.3 times net asset value, and when they need to raise equity capital, they raise it at a discount to that already hugely discounted valuation. And if ever they try and use debt to finance themselves, then they pay absolutely unbelievable interest rates on that debt, which destroys even more value. And I think the fact of having so many companies trying to do the same thing means that there's kind of a shortage of skills in the industry. I think, are there really 2,000 teams of top-notch precious metal geologists in the world? Well, probably not. So the pool of talent in the mining industry is spread far too thinly in the smaller companies sector. They're largely irrelevant to institutions because they're too small and too illiquid. Many of these companies have no analyst coverage, so there's no really reassuring or efficient or impartial distribution of information about them. And I think that the only solution really for this is a wave of consolidation. You put 10 smaller companies together and they have between them a massive saving in costs because instead of having 10 CFOs, you've only got one. Instead of having 10 boards, each with 5 or 6 people on, you've only got one. And by merging, they become larger entities which start to have access to institutional capital, and so they have a much lower cost of capital when they're making developments. I think that, is this going to happen anytime soon? Well, I've talked to lots of smaller mining company CEOs. They kind of all agree with the diagnosis of the problem, but none of them want to give up their jobs and merge with somebody else. So I'm not wildly optimistic about this. Doesn't mean that there aren't some companies that'll do an excellent job and perform, but I think the smaller companies sector as a whole is probably going to have a difficult time until some of these structural problems are resolved. So that's all pretty pessimistic, pretty bearish, and yet we're here to find out about which gold companies to invest in. So I do think there's some light at the end of the tunnel. I think that for the large cap companies, for the majors, the kind of behavior that we've seen in the past, where as soon as they've got any cash, they start investing, I think that's starting to change. I think for many companies, the near-death experience between 2011 and 2015 in that bear market, I think has left its marks on people's behavior. And I think Q3, although some people thought it was a mediocre quarter, I thought it was reassuring in that it was the first quarter which showed the effects of a higher gold price on free cash flow generation for the major companies. And I think what was good news was that few companies are ploughing all this money back into more capital expenditure. The priorities for this perhaps unexpected bonus in terms of cash that's come from the higher gold price, the priorities for the use of that cash for most people have been to pay down debt if they've got any, and many of the large companies have started to think about finally returning some of this cash to shareholders. And there were a number of large companies, Evolution, Agnico, Northern Star, Kirkland, Barrick, who all surprised us by increasing their dividends fairly significantly. And I think that's a positive message. I think the other positive thing which has happened over the past couple of years is that we have seen the beginning of some activism from shareholders. As you may be aware, the Paulson funds in New York fought a proxy fight with the board of Detour and removed the whole of the board and replaced them with perhaps more competent people, and since then the Detour share has more than doubled, and I think that was a positive indicator that managements won't. I'm done here, Eric. That's okay. I think that was a positive indicator that managements won't be allowed to get away with not optimizing the performance of the assets that are under their control. So I'll stop there. Thanks very much, everybody.
Really sorry
No problem at all. Don't worry.